Hi everyone. I believe we are live now. Uh, we have the participants joining in a moment. We'll begin in a minute or few once we have the most participants. Yeah. I think we can start and let others join. So Unnati, yeah, please.
Yes, sir. Good evening, everyone, and thank you for joining today's session. On behalf of True Ledger Consulting, I'd like to extend a warm welcome to all our attendees. At True Ledger Consulting, we support businesses globally through our integrated tax, accounting, and compliance outsourcing services. Our firm works extensively with US based companies, CPAs, startups, e commerce sellers, and international businesses that operate across multiple jurisdictions. Over the past few months, our team has received a significant increase in inquiries around the US year-end tax planning, sales tax compliance, book cleaning cleanup, and financial close requirements. Many business owners and finance leaders have been reaching out with questions on what they must complete before December 31st to avoid exposure and ensure a smooth start to 2026. With that backdrop, today's webinar has been curated specifically to address these concerns. Our topic for the session is US year-end tax planning and books cleanup activities, a comprehensive and practical overview of the key actions that the businesses need to prioritize at this stage of the year. We'll be discussing federal and state tax planning opportunities, required reconciliations, accounting cleanup steps, compliance of before we begin. I'd like to introduce our speakers for today's session. We are joined by CA Manish Agarwal, co-founder and partner at True Ledger Consulting. Manish specializes in US and international taxation, cross-border planning, and compliance advisory for businesses across multiple jurisdictions. Alongside, we have CA Ritvik Raj, CA and partner at True Ledger Consulting, and he also brings extensive experience in financial reporting, audit, ICFR frameworks, and global accounting operations. So I would like to extend a warm welcome to Ritvik Raj and Manish Agarwal for the session. Over to you, sir.
Good evening, everyone. And I see that we have a good number of participants here. I think everyone is very much excited here to understand the US tax and the accounting aspects here. So my hearty welcome to everyone here, and I hope this would be a very useful session to everyone, and there would be some value addition, and hoping that everyone would enjoy this session. And let's make this an interactive session so that there is a two-way communication, not just a one-way, and so that if you have will have the questions round as well, so we can address the question in the next in at the last at the end of the session. Okay, and we start this today's webinar. So is my screen visible to everyone?
Yeah, you can share this presentation with you.
Yeah. So the agenda for the today is like we'll overview of the year-end books cleanup. What are the US GAAP accounting, the significant accounting and the auditing aspects, the adjusting entries which you have to pass, after the closure of the books, then what are the documents and what are the financial statements, the components of it which we need to prepare it, and then locking of the financial statement so that we do not address and make the changes again. Then later on we have the reporting and compliance aspects. So what are the documents to be the file? Like here in India, we file with the MCA. Similarly, there are certain documents which we need to file in the US as well. So, so taxation is something that comes at the later stage, but that's a very crucial one because even if we prepare the financial statements, but still we see at the end when we file the tax and there are certain irregularities that comes up or something, you know,
Ritesh,
maybe.
sorry to interrupt. I think your slide is not visible. I think you are just sharing the D drive. The PDF is not yet open. Can you?
Okay, let me, but it's coming here that I'm sharing the window. So is it visible, Manish? Now?
No, let me share my screen and then I think better you can run it. No worries. Okay. So we have, you can, I'll move the slides for you. Okay. Think. Yeah, this is the agenda.
Yeah. So that's what I was speaking. So though tax come at the later stage, but that's very much crucial step because there may be certain changes in the financial statement, or maybe they're regrouping or certain things that we need to take into the incorporation at the time of filing ITR. But it's nothing that we have to like that should not be significant while making while we are filing the ITR. So that needs something readjustment or restatement of financial statement.
Yeah.
Yeah. Manish, next slide. Yeah, these are the objectives that we have to perform US GAAP compliant year-end closing process. Then we have to prepare the financial statement, understand the reconciliation requirements and the regulatory filings, which I said like we do in the India. Similarly, we have to do in the US as well. Yeah, next please. So what is year-end closing? So year-end closing is like we, uh, so during the year we prepare the books, we prepare everything, we prepare the financial statements. But though like we are booking the sales, purchases, everything, but we need to close the financials. We need to close the books. Okay. So that is the year-end closing that all your all your books should be closed with all the adjusting entries, with all the significant accruals. So so that there is nothing left in the financial statement any incomplete. So this is the year-end closing. So in this, we have to that constitutes of GL subledgers. Like you have to review your agreements. What are the contracts? IFRS adjusting entries. For example, like you have rent. Okay, you have your rent agreements. You have your rent contract. But in that, from you look into it whether there is anything significant for which you have to take into the financial statements. For example, like like security deposits. If you have not booked it, then you can identify if from the agreements or from the contract that is there any such kind of security deposits or not for which you need to book it in the setting, book it in the financial statements, book into your books. So that is just one example for it for the year end closing. Then after your GLs and subledgers, you need to reconcile your GL and subledgers. Say that as an example was with the rent agreement. Similarly, you need to check your debtors, you need to check your creditors, and all these are reconciled or not. Then coming when your GL and subledgers are reconciled, okay, the next step you have to prepare the financial statement. You have to make the financial statement ready for your auditors because they would be coming and they would be doing their audit as well. So like when you're finalizing all your financial transactions, you have to ensure certain of the parameters like your bank reco is complete. You have booked all the interest income, whether it is your fixed deposit interest income or any other accrual incomes which is coming here. Then you have to make the provision for the tax as well. You have to compute what is your tax coming, and accordingly you have to book the provision as well. You ensure accuracy of the financial records. Like as you like you have trade receivables, trade payables, inventories you have. All such you have to ensure that those all the financial records are complete. For trade receivables, for example, you need to do the confirmation. You have to inform your parties that you need the ledgers for it so that you can check whether what is coming in your books and the books all are reconciled or not. If there is some gap or some disparity, you can take into account and book it correctly. The next step is like when your financial statements are ready with all accuracy, then you need to the audit. After the audit, you have to do the certain statutory audit compliance. Like you have to file the documents with the SEC. SEC is like for the listed clients. Okay. In US, what is happens that all the companies they don't have to audit is not required. There are certain like listed companies. Okay, for that the audit is required. And for other private limited companies, audit can be done if it is on the request of the investors. There's a PCOB board, like those firms which are registered under the POC, they do the audit for the listed clients. Then this is certain Sarbanes-Oxley Act of 2002. There are certain internal controls as well. So those internal audit that has to be done as per the compliance of the Sarbanes-Oxley Act 2002. So as I said, the private limited company no mandatory audits on the voluntary basis. Then you have to freeze the books when everything is finalized, your books are ready, everything. So you have to lock your books so that you don't have to go again and make the changes, anything. Okay. So once it is done, it is done. So you have to freeze the book, lock it, and so that there's no significant, no, you don't have to make any changes later on. And the last step is like return filing. So that I'll also discuss like what are the forms to be filed in the and later on. So typically the US closing calendar, they follow the calendar year like from January to December. But before December, you have to take like you have to close the books. Okay, like October to November is the pre-close review. You do all the reviews. You have to do all the adjustment entries. You have to match the GL subledgers. So that is the time we have to just reconcile our books. Then December is the time like provisions, accrual entries, inventory, depreciation, all the adjusting entries, you have to take it and close and make it a book ready for the auditors or maybe for the income tax ready for it. So January, like there's certain time like 1st to 10th or something, there's a time period. On that basis, you just rectify all the books and close the books for the books are closed so that you don't make it any more changes. Then later comes the ITR, income tax return filing time, and the documents which have to be filed in the ACC and that is 10Q. Okay, 10Q, 10R. These are documents which are need to be filed. Yeah, Manish, next slide. So as I said, discussed earlier, so now what you have to do in the general ledger review, you have to validate all entries posted, like the contracts, the agreements, rent, okay, depreciation, everything has been finalized. So you need to compare the GL and the subledgers. So all that the tallies, the normal ledgers tallies to the subledgers. That's the thing. You have to correct any misclassification. Like for example, there's a one expense. So if you expense that relates to, for example, administrative expense, and you have passed that to the, for example, subscription expense. So all that you need to check the misclassifications and pass it on the correct account, ledger account. We all read about there are certain errors like commission error and omission errors are there. So all that you need to encounter it and correct those errors. If like there's a if there's a difference in the amount as well. So when you're comparing to the GL subledgers or the agreements and the contracts, you come to know that there are certain errors in the books. So that is the time you have to make the certain changes and correct your books as well. Review the suspense account. Suppose, for example, an amount has come from a debtor, from a party, trade receivable party, and you do not know whether from which party that amount is come. So that is part of the suspense account. So before the closing of the books, you need to identify from from which party the amount has come to you, pass the necessary entries, and correct your books account. So then trial balance variance, always you have to ensure that a trial balance matches the thing. The next come the accounts receivable closing. We know that how do accounts receivable they are correct. So in this accounts receivable, you have to identify your sales and what is the trade balance coming in your books. Accordingly, like there are certain checks by which you can correct your accounts receivable parties. Like you can ask from the your trade receivables parties the ledger balances, and then you can compare their ledger balances and our ledger balances, and based on if any kind of differences is there, that can you can sort it out and we can correct the books. Then there's another step like confirmation also. Okay, we need to float confirmation. Okay, float confirmation to all parties that this is our balance is coming. So please confirm what is your balance at your end, what is coming. So, and then you can obtain the confirmation either by email or by post. And by that you can come to know by that relate the confirmation which has come to you, whether any differences or not. If there are differences, if there are no differences, then that's good. But if there's differences, then you have to take the effects of it and rectify it, whether your balance is correct or the party balance is correct. Accordingly, you have to take that step and adjust into your books. Similarly, the process what we do in the accounts receivable, similarly the same is the process in the accounts payable as well. Same here, you have to ledger reconcile it, obtain the confirmation, okay, and the accruals of it. For example, like you have made the purchases during the, but you have not, you do not get any invoices for them. You have to book the accruals for it. And then in the next step, you have to identify any open POs or not. Okay, so if there are certain open POs, then it means that there it can be like capital items. So accordingly, capital creator would be there, and accordingly you have to book into your the amount into your books. Yeah, Manish, next slide. This is a very important, crucial bank reconciliation. So I think every must one must be, or if they're not knowing how to reconcile the balance, and I'm telling, this is a very crucial step for your proper maintaining the books, that bank has to be reconciled. Okay, for this reconciliation, you need to obtain the bank ledger. You have to check the entries. What is the differences coming in your BRS? Accordingly, we need to rectify the differences coming. Okay, then other step you can take in this bank reconciliation is like the bank confirmation. As an auditor, it's a very important and crucial step to obtain the bank confirmation. Okay, because the auditors also coming, they would, if they do not get the bank confirmation, they rely from the bank statement and the if the confirmation is with the client. Okay, so bank reconciliation is a very crucial step in this closing door books. Then from the bank reconciliation as well, you can identify any there's any interest income or deposits. And if you have not booked those into your in books, then accordingly you can book it. So inventory closing, another important aspects, and this is very much important if it is a trading concern or manufacturing concern. We find the inventory like you need to do the at the year end, you need to do it the physical verification of it, the inventory. And then physical verification, after doing the physical, you need to do the valuation of the inventory. So there can be various methods of the inventory valuation. That can be FIFO method or weighted average method. Okay, so accordingly we need to book the inventory as well in the books. And you have to identify if any damage, obsolete items, and for this we need to take the provision as well. Then property, plant and equipment. So in this property, plant and equipment, it all depends upon the process of the company. Like how do they do uh, mm, maintain the fixed asset register, and as well the physical verification of it. Like in India, we need to do the physical verification of the property, plant and equipment at some regular intervals. Okay, so and for this property, plant and equipment, you need to have a proper, fixed asset register. A fixed asset register basically contains the location of the location where that asset is, the primary, whether it is plant and machinery, office equipment, or something. That is the main group and the subgroup. Okay, the purchase amount, the asset code. Example, this is the property, plant, equipment. These are the basically items which contains in the property, plant, and equipment. So in property, plant equipment, like you have to post a depreciation as well. And for depreciation, you have for this, you need to get the useful lives of the assets. And if during the year, if you have sold the asset, there would be some significant loss or gain on those asset disposal. Accordingly, we have to need to take the adjustment in our books. Yeah, Manish, please next slide. Then accruals and prepaid. As I we discussed later on, like okay, for example, if there is any kind of accruals we need to book. Accrual is something like the services has been performed and you have not received the invoices. You have not received the bills from your vendors. So you, accordingly, we have to book. You have to make a provision in our books. For example, like if it is, for example, it is like something. Uh, mm, yeah, electricity expenses, for example. Okay, though the expenses, the services which we have consumed, but we have not received any bills of it. So accordingly, we have to make estimate of it and book the provision in our books. Okay. Then again, some, for example, purchases. You have made some purchases, but the invoices you have not received. So you have to get a confirmation for what is the amount from your vendor, and we need to book that accrual. So prepaid is something like insurance expenses. Okay, so so prepaid, we know that we have to amortize the prepaid expenses, and so we need to book the expenses in our books. So prepaid, which can like insurance, rent, software subscriptions, these constitute the prepaid expenses. Then we have borrowing. Borrowing, like if you have any borrowings, short-term borrowings or long-term borrowings. So here, while you are making ready with your financials, you need to check whether it is a concurrent current item and non-current item. Current item is something, like you're making the principal repayment within the 12 months. So that will be a current. And if those principal payments which fall after the 12 months, that will be non-current items. So you need to have a bifurcation of this in your financial statements. In borrowings, you also, another thing you need to check is like how much you have made the principal repayment and the interest part of it. And you have to book the interest as well in the books. So for this, the best thing is like you need to obtain the repayment schedule from your borrower. Okay, from whichever company of the loan has been borrowed, check that statement. And if it is possible, you obtain the borrowing confirmation as well. Then the next important, the very crucial aspect is like the tax provision. So when you have read, when everything has been closed, your P&L part is complete, then you need to have a provision for the tax. Okay. So like what is your tax coming? So you have to make a computation of it, the tax, and book the provision in the tax. If so, everything you need to reconcile your withholding tax and the tax which would be coming. So and make a provision of it. Your money please come to next slide, please. Yeah. So I want to take up this payroll closing. So like as we do here in India, similarly you need to comply with the payroll. So there is something like the weekly or in some companies there is bi-monthly processing of the payroll. So you need to have a payroll closing. Okay, book all the expenses for the payroll uh, so that your books are ready and you have the financials. In the financials you have the amount, payable amount, and the expenses amount. So and yes, so you need to do a reconciliation of the payroll as well. So like similarly, like as we have here in India, TDS is there. So similarly, we have in the US as well, that is withholding tax rate. So we need to file the withholding tax return, and that is filed quarterly as well. So Form 94I, that is the withholding tax return, and that is the quarterly federal tax return here. That is filed by the employer, and they report what the salary part and the tax to be deposited. Then in US as well, we have the social, like as we have in India, the PF, ESI. Similarly, they have the social security schemes that also the employer need to file it. In US, the another thing is that the people get the employment, you know. allowances they get it. So that is FUTA and the SUTA. The FUTA is the federal unemployment tax. So it FUTA governs the federal unemployment tax and that is used to fund unemployment compensation programs. And for this FUTA, it is the employer they have to pay. Form 940 is their employer's annual federation unemployment, that is the tax return to be filed. So similarly, like FUTA, we have on the state basis, we have State Unemployment Tax Act. So it is like applicable in state-wise as well. It's not that every state has that. Yeah. So it's a mandatory employer tax in all states, and only a few state employ they have the employee contributions. As we said that it has to be contributed by the employer, but there are certain states, where employee also need to contribute it. So W2 is is for the payroll, like as we have in India, Form 16. Similarly, the tax statement they file it is that is WT, and WT and W3 is also there. That is your just a summary of the transmittal of the wage and tax statement. And 401k, which constitutes the employer sponsored benefits, health insurance, group insurance, such thing. Yeah, Manish, please come to the next slide. So these are the adjustment entries. When your books are ready, the auditors they come, the auditors they come for the audit, and in the mid of the audit, there are certain entries which are identified by the auditors. And if there is no audit as well, if you are reviewing the books yourself, and then you identify that there are certain entries which was not passed, so for that you need to park an adjustment entries. So so in the trial balance, what we generally do, when we have a trial balance, there is a separate column for the adjusting entry, and we do the adjustment and make the financial statement of it. So there can be adjustment entries, anything like in for the inventory, for example, inventory for you have to make a provision of the inventory, or you have to depreciation, you have forgot it, you not park it, the depreciation expenses, then you can make an adjustment entry of it. Yeah. Then we need to close the books and send. Then the year-end reporting comes. So year-end reporting, like as we prepare in the India, the balance sheet, income statement, cash flow, equity statement. Similarly, we have to prepare for the US as well. There also we need to prepare the balance sheet, income statement, cash flow, other comprehensive income, notes to account, and MD&A report. So MDNA is basically it's like director's report there. The same we have in India we have the director's report and there we call the MDNA report. It is just a narrative analysis section which including the company's annual and often quarterly. These are public reports typically accompanying the audited financial statement. So MDNA is a required disclosure under regulation SK specified item 303, which it generally contains the business overview, operational analysis, liquidity, capital resources, the accounting estimates, assumptions, and the trends and the business risks. Yeah, as we do in India, the year-end filing with the MCA. Similarly, we need to file in the US as well. That is a 10K filing. The 10K, those companies which they are under the obligations to file the annual report. So for that is a 10K. So 10K is the report which we need to now file in the US. It's a as we said, the public traded companies, the listed entities, they need to file it with the USA. Then we have another 10Q that is a quarterly statement, just like 10K, we need to file it. It's a quarterly summary report which we need to file it with the with this US department. Then there is a one form 8K current reporting. This is filed whenever there is a material event that occurs between the mid of the year, something like major acquisitions or disposal when death has come, or bankruptcy or restructuring. So in that case, we need to form 8K. So, and then there's various tools like as we have in India, Tally. There are also like certain softwares by which we can prepare the books. That is, we have QuickBook, we have NetSuite, then we have SAP, Oracle. Yeah. So it's like a company jurisdiction as well. Like in US, QuickBook is more followed there. Okay. Then in another region, there is NetSuite which is followed. Yeah. Then we have another Zero also. That is we basically used in UK. Yeah, Manish, please next come to next slide. Okay, we can do this later on. Next one. Yeah. So once you are ready with the books, you need to have some year-end checklist as well. Like a team planning event, you need to, have a team planning event, a document which basically that contains that you have discussed it on all the aspects of the accounting aspects. You are ready with the books, and you have discussed the important aspects as well. So you need to document that in the team planning event. Uh, okay, the certain aspects, revenue recognition, inventory, and the other accounting aspects, okay, which you found it very much crucial as per the nature of the business you have. So you need to document in the team planning event and the books and the timing of the time which you have closed your books as well. Then for the year-end audit checklist, there is one SOP, that is standard operating process. You need to have a standard operating process for your revenue, purchases, fixed assets, and fixed assets. Then you have inventory and cost of sales. If you have a consolidation, then for the consolidation. So whatever the significant accounts you have, you need to have an SOP of it. And SOP is a structured document which tells you about how the process is followed in your organization. So it's also one of the documents that is very much useful while doing the internal control audit of it. So there's impairment testing. So it's upon the management, that management they have to do impairment testing of it. So there are certain bases and the criteria for doing it. Impairment testing. So memo on revenue, as we know, the revenue is certain item which is considered as a fraud risk. So you need to have a memo of it, like why this revenue is not why do you consider this is not a fraud risk for you? So you need to have a memo of it, document everything about it, like how you have substantiated it, that it is like a crucial step, but you have taken the steps like to mitigate the risk of it. So there's no fraud in your company with related to revenue. Then every organization is exposed to certain laws and regulations. They may be like certain laws, like suppose if it is a medical industry, then it has their own laws. If it is something environment related industry, they have their own laws and so you need to be compliant with those laws and regulation. Then management testing on IFC. So that is the internal financial controls. So management, so they should have a document of it that they have tested those controls and they are okay with it. So they need to have a proper supporting of it, that all the test has been conducted on the internal financial control, and they have a ready document of it and they are satisfied with it. So yeah, Manish, please come to next slide. Yeah. Then in this we have another important feature which has recently come into the accounting software QuickBook, that is the Intuit Accountant Suite. Okay, and this is a feature which you can call it an AI feature in the QuickBook, where in this like if you have a lot of clients here and you are want to track on the basis of AI that which is your best client, which is the most profitable client to you, or some there you have resources and which are underperforming resources. Okay, the payroll thing, like which is something the employees which are low paid, or some of the employees which are highly paid. So that there are certain AI based on the search criteria is in this software, and you can search on these parameters, and that's come. There's a very useful tool that has come with the Intuit Accountant Suite. And so you can more navigate on this and search on this, and you'll that thing I think that would be very helpful for you in this. Yeah, Manish, please come to the next slide. Yeah, this is all about something the Intuit Accountant Suite. We will share this PPT with you, and you can come more about this on this the Intuit Accountant Suite. Uh, yeah, I think this is all about the accounting aspects. So from my side, and I hand over to Manish now, who would be taking the next round for the taxation. Yeah, Manish, please.
Thank you, Ritvik, for very insightful session and covering the basic part for a tax professional to do. That is the accounting. If it's done right, most of the cases the tax accountant or the tax professional efforts are significantly reduced. So that's why accounting always comes before tax, but usually it's the difference that we accountants get creative at sometimes and try to uh, put tax first and then accounting later. But that should always be the ideal. So the agenda for today is my screen visible to all, I hope, and visible
Yeah,
to the
Manish, it's
mic and
visible.
camera.
Yeah, yeah.
Yeah. Okay. Okay. So the agenda for the tax point of view is uh, recently in the month of July, significant changes were introduced by Mr. Trump through a bill or an act called One Big Beautiful Act 2025 that was passed on the Independence Day of USA, 4th of July. So that created lot of planning opportunities or action points that a business need to consider specifically for 2025 tax year. So we'll see on a high level basis what are those key changes that have been introduced by One Big Beautiful Bill. Then some tropical planning opportunities, given that the year end is there and we have some days left, and also the estimated tax deadline for the fourth quarter is around the corner. How we can proactively educate our clients or uh, educate ourselves so that we can advise clients to how to take actions in the coming years or in this year to mitigate the tax exposure for future years and the current year. And similarly, we'll be doing this for both for the individuals and the business taxpayers. So now let's move to the uh, recent changes by the One Big Beautiful Bill. So, what is the agenda for this One Big Beautiful Bill? So, this was a bill which is uh, uh, on the radar of the US new government. I think in January 2025, the new government took the charge, and this tax policy and this legislation was very much the part of the agenda of the Trump's government, that they want to give some tax relief to the middle class people, relief so that there is a more disposable income over there. They also increase the overall tax slabs and the rates so that there is a lesser tax burden with the uh, individual taxpayers over there. Uh, Alongside, I think there is some shift in the policy, which is a overall shift in the US on the uh, green energy towards the ESG. So they have rolled back a lot of incentives that were introduced for energy efficient homes, energy efficient vehicles, which was introduced as a part of Biden government in 2022. So many of those incentives were rolled back, and uh, now a lot of brackets have changed. New standard deductions have been introduced. So overall, there are a lot of planning opportunities coming up with this bill coming in force. So we'll see some of those specific aspects now. So currently in US we have uh, seven different slab rates ranging from 10% to 37%. Now all these slabs, earlier there was a concern that whether these slabs were uh, phased out after the Trump or whether these would be permanent, because these were slabs were introduced on a temporary basis by the Tax Cuts and the Jobs Act in 2017. But now these slabs have been made permanent with a provision for inflation adjustment. And now the new inflation adjusted slab rates have also been defined. So the first slab rate for, if I'm looking at a married filing jointly, it starts at 23,850, and the highest slab rate at the 37% bracket is 751,600K. So somewhere between 23,000 to 751,000, you are at a highest bracket, and up to 23,800, there is no tax, and above uh, sorry, up to 23,850, there is a 10% tax. So this is the slab rate, and in general what we observed is that between uh, 12 to 22% bracket, a lot of margin is there. So people with income, let's say up to 206K, can be now in uh, uh, 22% bracket. So a lot of room for planning. 200K high income earners would be within the moderate range of bracket. So this leads to a lot of planning opportunities or to stay within the tax bracket and pay low tax, and creates predictability in terms of planning your gains or losses or expense deductibility over a multi-year span, so that your tax bracket is quite significant between 96K as a 12% and 206K for the 22%. So there is a window of opportunity there. Now, standard deduction, again, this has been made permanent now for the 2025. Single is 15,750. For head of household is 23,000. And for married filing jointly is 31,000. Again, there is an inflation index provision. And the standard deduction is like in India also we have 50,000 and 75,000 INR as a standard deduction. So standard deduction is like a substitute. You don't opt for any itemized deduction, but you go for a one single. Uh, so in US also there are itemized deduction and there is a standard deduction. So if you opt for an itemized deduction, you cannot go for a standard deduction, but you opt for uh, uh, basically standard deduction up to 31,500. I believe the tax liability would so anyone income up to 31,500 it should be nil. Yeah. So that's the standard for US follows. So with the increase in the limits, the standard deduction, the objective here, like in India, is to reduce the exemptions and the allowances. Same way in the US also, they want to reduce the itemized deduction and focus more on the. I think from an individual tax planning would be charitable contributions. There are some other ways which you can use to uh, minimize your tax liability in terms of charitable bundling through. Uh, uh, Deferred funding plans wherein you can fund donor advised funds, which is called similarly for child credit. I think there was the earlier the limit was somewhere around like 1,400 to 1,700. So a tax credit and a deduction is different. A tax credit is a dollar to dollar tax credit, means a deduction reduces your income, whereas a tax credit reduces directly your tax liability. So the tax liability, the tax credit is $2,200 for a child per child, and it is indexed to inflation. Now, certain new above the line deductions. So, I'm sure many of you would know the concept of above the law or below the line. So, above the line is the deduction that directly reduces your gross income, and below the line is after your gross income is calculated, those deductions are there. So, for charitable funds, particularly, even if you are going for a standardized standard deduction, you can still claim some nominal amount of charity contributions as a deduction. This is effective from 2026 in particular. For 2025, you still have the uh, option of going for a adjusted gross income. There is a 60% generally cap of your adjusted gross income on the charitable contributions. Okay, so for this particular year, up till I think 2025 till 2028, the deduction for state and local taxes that you pay. So the deduction is only for state and local taxes, not for uh, federal taxes, but for state and local taxes or like your property taxes, municipal taxes, any taxes that you pay, you can claim it as a deduction in your federal income tax return. This is up to 40,000. Earlier, the limit was up to $10,000. So this limit has enhanced significantly 4 times, and this limit is 40,000. It will increase in, from inflation adjusted up to 2028, and thereafter after 2028 the limit will restore to 2025 pre-era, which is $10,000. So the action point here from a planning point of view is that if you have any particular like municipal taxes which is assessed and you want to pay it, or let's say it is due by next year, but you can, if you want to prepay it, or if it is due, for example, but let's say you still have time. For example, it is you received the invoice or you received the bill, but it is due, let's say by 7th, maybe if, of January, you can plan to pay before 31st of December so that you can get an enhanced deduction. So, uh, so you can accelerate your assessed property taxes only if payment is actually due and assessable. Yeah. So you need to show the proof that okay, you are not paying it as an advance or something, but it is an actual receipt. So there is a phase out. Phase out generally means that after a particular amount, your income crosses, adjusted gross income crosses, the benefit of the full deduction is curtailed to an extent. The percentage of phase out that is calculated. So up to if you are 500K income, you will get a full $40,000 benefit of state and local taxes. Now, this is one important thing, I think, estate and gift tax basis, and we'll cover an example here as well. There were certain doubts, I think, before this Tax Cuts and Jobs Act. The limit was for a so in the US there is an estate tax. So estate tax is applicable on the person who inherits the estate of a deceased. Yeah, in India, like in India, gift tax we have. In USA, the gift tax is on the donor, whereas in India, for example, the gift tax is on the recipient under Section 56(2) we have. So in US, it's the opposite. It's the donor who bears the gift liability, and for estate, it's the person inheriting the estate. Now, under the US, there is a lifetime exemption allowed, which is up to 13.61 million before this one big beautiful bill, which is now increased to 15 million per individual. So if it is a couple or a married filing jointly person, the limit is $30 million. So up to $30 million, you can gift your assets to your to your to your legal hires or to your as a charity, as your legal hire or anyone. So up to 30 million, there is no tax. So, and this limit was supposed to curtail to half before this one big beautiful bill, but after this one big beautiful bill, the limit has been restored permanently with the inflation and index provision. Now, what this the US environment, particularly given that there are by-elections due in 2026 mid, there is high possibility that this to high limit of 15 million would be reviewed or there would be close scrutiny on this. So they should consider, if not that before this limit gets changed or curtailed or there are new regulations, you can use to use some part of the limit to where you feel that the asset is underappreciated or undervalued now, but you feel that there is a high potential of appreciation over there, like illiquid stocks or startup stocks that you hold. You can gift it as an or is to an a trust through an and wherein when the future asset appreciates over there, uh, it will not be taxed because it is now gifted to a trust and you use the exemption limit. So by the time the asset appreciates over a period of time, the asset passed on to the inherit legal hire, it doesn't get taxed. So we'll see an example here. Let's see. So let's say I have an asset which is in the nature of an illiquid stock, and the value of asset at death, assuming let's say 10, 15 years from now, it would be assumed is $21.6 million, for example. And assuming that the person has not used any of his lifetime gift tax or estate tax exemption limit, which is 13.61 million for 2025, and for 2026, it's like 15 million. So for 2025 and up till accumulation, there is no utilization of this limit. Full amount is available. Now, if that person uses this without any gift or something, the other person dies. And today, if one have to calculate the estate tax liability, it would be the fair value of the estate at death, with, let's say 21.6 million, and the exemption amount is 13.6 million. So 7.9, roughly 8 million would be the uh, estate taxable amount, and the amount of tax would be 40%, or assuming it would be like 3.2 million. Okay. Now, let's take an example wherein you gifted your asset. Let's say there is a 7 million of asset, assuming that the person is supposed to die like 10 years, we are assuming a scenario. Well, okay, so let's say a person gives 7 million in gift using, because it's an illiquid stock, uses 7 million of exemption. Remaining exemption would be 6.76 million, because 13 million is the total lifetime exemption. So if I gift 7 million worth of asset now as a gift, I would be remaining with 6.6 million. And now the gift is given to the trust. Now the trust did hold it as an asset, and the asset grows to $21 million over the period of, let's say, 10 years. Now, at the time of death, whoever inherits the beneficiary of the trust hires this. since there is no business interest over there under the US rule, uh, the entire amount of asset that I inherit from the trust would be tax free because I have used my lifetime exemption and the future appreciations over there are not taxable there. Uh, so it removed the asset plus all future appreciation because this smart move of gifting it now while utilizing the uh, exemption available till now. So the lifetime gift exemption is a very valuable. We should use it if you feel that a person is considering is ill or is nearly on a. This gift exemption is something which can significantly reduce the future estate tax liability on the hands of the inheritors. So from energy tax credit point of view, there are certain energy credits, as I said, that are available by the Biden government, but they have now been phased out. And for example, energy efficient home improvement, no energy credit would be available for asset placed after 31st December. So if you are in the looking to get some tax credits or you have uh, made an investment on the basis that that you will get the credit, you need to accelerate your construction or your project so that you meet the timelines provided in the law. Similarly, for residential clean energy credits, the time limit is now December. So for some it is December, for some it is 30th of September 2026, and for other it's like June. So there are multiple timelines available in the bill, which we need to study and advise our clients accordingly if they are interested in any energy efficient credits. Now, certain new provisions which are uh, making quite a buzz over there in the recent days is like, for example, seniors which qualify for extra 6,000 of deduction tips. There is an additional amount of deduction given, which is like a below the line adjustment, which is like 12,500 and $25,000, which you get as an adjustment. I believe these are the amounts, 12,500 and uh, yeah, no tax on tips. So on overtime, it's 12,500 and $25,000 for merit filing jointly. And on tips, it's $25,000 for the qualified tips. There is a FICA tip credit as well, which the guidance is coming up from the IRS in the coming days. We'll see if we can host another session to cover more business opportunities coming from the IRS guidance as the Christmas season goes on. The IRS will issue more guidance on the one big beautiful. We'll cover separately over there. But yeah, these are the some notable provisions like car loan interest deduction up to 10K for US assembled cars. Trump account is a new investment vehicle, saving vehicle for putting up your employer and charitable contribution routes and for saving. So it's an additional kind of a saving plan, Trump accounts. These are like your retirement saving accounts like Roth IRAs or something like that. So pretty much new, not any significant guidance available over there, but it's more like a saving instrument for the benefits of individuals under 18. Yeah, so I think we have some time, and I'll just quickly cover some of the uh, individual tax planning strategies which may be relevant. So bracket management is something which is very popular. Like in India, also we have slab rate management. So bracket management means, uh, let's say, if you're about to have a income, high income, you spread out your income in the years in which you're on a low tax bracket, and you try to put your expenses in a year in which you are on a high tax bracket. Or mm, that's pretty much the thing. You want to defer your income over a multiple years so that you don't uh, get out of a lower tax bracket and end up paying high tax. So that's the whole objective of bracket management. That uh, over a year, so the how do you do a bracket management is that you project a 3-year taxable income curve. Like you uh, sit with your client and understand like what is his income stream in going to be in the next few years, like whether he is going to sell his ESOP, or there could be a residential property sale, or could be a capital gain, or whether there could be a withdrawal from a 401k plan or IRA. So those kind of scenarios you build in the model, and you see where your client lands up in terms of the bracket. And then you try to manage those bracket by shifting income from one year to other, or maybe to see that how the overall tax scenario is optimized. There are tools and Excel modeling sheets available on the market, and also you can develop your. We have also our custom made Excel modeling sheet where we use to how to model the multi-year tax and inputs. Based on this, you can manage the brackets, and then we see how is there any gap left, or is there any spare amount or capacity left, if we can fit in within that gap or a bracket, if we are managing it, and see, if the overall tax scenario or the cost is optimized if we do a transaction, let's say in a multi-years versus doing it on a lump sum basis. So that's how the objective is for the bracket management. Now we'll see the bracket management specifically from the lens of a 401k plans, which is quite common. I think many of you would be hearing on the LinkedIn and the social media, like Roth conversion, 401k conversion. These are the conversations that are we typically see from our clients. So 401k plan, I'm sure many of you would know, or the 401k plan is similarly like an employer sponsored defined contribution plan. It's not a defined benefit plan, it's a defined contribution plan wherein an employer contributes a specific amount, and the employee also contributes a specific amount. The contribution from the employer could be the matching amount, or it could be lower. An employee can also contribute a higher amount. Yeah. The Now in US there are particularly two types of retirement plans. And there are other types of retirement plan like IRA, but we are not covering the IRA specifically because it would be too lengthy. We are just focusing on 401k because that's the most common. So 401k can be of two types. One is, it could be of a traditional 401k plan, which is like you, it is a pre-tax contribution. It means whatever contribution you make as an employee, it get deducted from your federal income, and whatever contribution your employer make, it doesn't get counted in your taxable base. So it means at the time of contribution, both employee and employer doesn't suffer any tax portion. But at the time of liquidation, we'll see later, it is uh, fully taxable as a ordinary income, because you get the tax deduction at the time of contribution. So any further accumulation and principal plus distribution that you get is fully taxed. Whereas in a Roth 401k, what happens is whatever contributions you make now, they are not tax deductible. They are taxable, added to the taxable income. So both employee and employer. So in general, and you can select to, an employee can elect to have their contributes to either 401k or a traditional one, depends. You can choose whether you want to go with a traditional or a Roth, and you can make a different one. Let's say you can contribute your share in a traditional, whereas employer in a Roth or a traditional, depending on your overall scenario. For a bracket management purpose, you can see, we can see a example on this aspect as well. So as I said, for traditional 401k plan, the full amount of withdrawals or the distributions from the 401k plan is considered as taxable, because the amounts were earlier considered as deductible and non-taxable in the hands of employee. Whereas in a Roth 401k, since the tax is paid at a front loading at the time of contribution, subsequent distributions are considered as non-taxable. There is certain criteria which is called 5 years and 59 and a half year rules. So if you withdraw your 401k balance after 5 years and 59 and a half years, generally the amount is considered as non-taxable. Uh, but if you withdraw before this period, let's say for 5 years or 59 and a half years, then only the interest portion is considered as taxable. The principal portion is not considered as taxable, because it is anyways you have paid tax at the time of the contribution over there. So now let's take a practical example on this. How do you select a 401k plan, whether to go with a traditional one or a Roth one, and how do you manage the bracket given the your slab rate? So this is a fact. a US guy, Paul Smith, is a 55-year-old guy. He wants to contribute $15,000 into his retirement account for the current year. He is eligible to contribute to either Roth or a traditional 401k. So in the US also, there is a ceiling or a cap that you can contribute only up to this some much amount to a Roth plan or a 401k plan. For IRA plans, generally the ceilings are low, so most of the people do not qualify for IRA plans if they are high wage earners. But for pretty much the other people, 401k plans are something which traditional or Roth 401k plan they can do still do the. So Paul is able to contribute to either traditional or Roth 401k through his employer, who provides a dollar to dollar matching up to $10,000. So it means an employee wants to contribute 15, and his employer will also contribute up to $10,000. So there are, as I said, there are AGI limit. AGI stands for adjusted gross income, is above the AGI limits for making contributions to Roth IRA and for deducting traditional. So IRA limits are based on the income. So he's an high wage earner, so he does not qualify for IRA plans. Current income tax rates are historical lows and generally expected to rise or increase in the, for example, in a scenario where we believe that income tax rates would increase in the future. Paul is currently at a 21% of marginal tax bracket, and he expects to be in a much higher bracket in future when he starts taking distributions from his investment, because obviously uh, he makes his wages would increase, he would have a house, he would have shares or capital gains, so something like that. He believes that in the next few years his tax bracket would be higher compared to now. Currently he's at 21, for example. Now the issue before us is how much of 15,000 of the retirement contribution he should make to either of a traditional plan or a Roth 401k. Now, our suggestion in this scenario, specifically with the limited facts, is that all 1500 should thousand should be contributed to the Roth 401k, for the simple reason because Roth 401k, the tax is front loaded at now, and the distributions are tax exempt at a later point when he would be at a, whereas traditional tax is not front loaded, but it is taxed at a tail ended basis. So now, given this scenario, when the Paul is at a low tax bracket now, we would definitely want him to be taxed at a low bracket now instead of when he would be at a high rate, because under the Roth plan, the distributions will become taxable. If they become taxable, he would be at a higher bracket. Whereas under the traditional plan, the distributions will be taxable at a significantly higher rate. So that's the reason we want to go with the. So uh, Paul should contribute to the Roth 401k rather than a traditional plan, because Paul is currently in a lower tax bracket and expects to be in a higher tax bracket, since he expects to start taking 10 years from now. The 5 years ago requirements for a qualified distribution will be met, and the entire distribution will be tax free. So that's the reason we want him. Otherwise, in a traditional 401k plan, what will happen? He will get the deduction now, but his entire income would be taxed in a later stage where he would be at a higher tax bracket. So this is how you manage the bracket overall from a tax point of view, and see in which year you want scenario you will be at a high rate or a low rate, and depending on, you will choose your decision whether you should go for a traditional plan or a Roth 401k plan. I think we are uh, more than the time, but if participant permits, can we uh, go by a, let's say, on a chat, or someone can say that we can go. I think if people are still there, I think we can there, or otherwise, I think we are off the time. But nonetheless, uh, we'll share this material with all of you. Since we are off the time, we apologize for the additional time. But yeah, it was really interesting session, and we believe that the insight shared by us and Ritvik would be helpful to you. And
Yeah.
we'll,
Thank Manish, it
I'll
was
ask.
a like the way you imparted your knowledge and tax, it was very insightful, and I hope the participants they would be really enjoying and have gained some value additions in the tax part.
Yeah. So while would like to cover the business aspects of it, but there is a lot to cover. But yeah, due to paucity of time, we will not be able to cover the everything part. But yes, would be happy If to connect with you, all our contact details are mentioned in this slide. I and Ritvik are there to help you for your any accounting and tax related queries. Uh, Much happy to connect and share your our insights further and discussion with your client and having queries. I'll ask Unnati to give a formal vote and close the session. Thank you, everyone.
Yeah, thank you, and thank you, moderators as well, Unnati, Shefali, and
Thank
the
you.
True Ledger team for such a successful webinar, hosting a successful webinar. Thank you.
So, as we come to the close of today's session, I'd like to thank all our attendees for joining and engaging with us. And we appreciate the strong participation and the thoughtful questions throughout the webinar. Also, thank you once again for your time today. Wishing everyone a smooth and compliant year end close. Have a great evening.
Thank you. Thank
Thank you,
you. Bye
everyone.
bye.
Thank you. Bye.